So this next mini section, we're going to concentrate on retirement planning. And I think now more than ever, saving for retirement is really, really important. We've got an ageing population. With advances in medical science, people are generally living longer and being healthier in retirement. So there's increased costs of living, generally speaking, and we need the money for longer. The effect and the effectiveness of the state pension schemes, of course, has diminished over the years. And when you add all of these things into the mix, it generally is a perfect storm of a retirement problem that's bubbling under the surface, waiting to explode. And for those of us that want a comfortable retirement, to enjoy things that we become accustomed to now in retirement, then generally speaking, we're going to have to start putting much more money away to meet our needs and requirements. So looking at some of the basics regarding retirement planning, state retirement age is now gone up to 66, with plans to raise it to 67 in 2028 and then up to 68 by 2040. Who knows whether that will stick or whether that will be brought forward. Chances are it probably will be brought forward. So most personal plans give you access to pension plans from age 55. And if you're in an occupational pension scheme, then you'll be governed by the scheme retirement age, which typically is going to be somewhere between 55, but more commonly closer to 65. There is a limit on annual contributions, which is known as the annual allowance. The current level is shown on this particular slide. And likewise, there is also an overall limit on savings, known as a lifetime allowance. And again, this goes up every year, and the current figure is shown on the slide in front of you. So generally speaking then, individuals will save into an investment product known as a registered pension scheme during their working life, and essentially investments that are made into registered pension schemes are very, very tax efficient, with there being very little internal taxes within the actual pension pot itself, and also pension tax reliefs available on money that goes in, and the ability to draw money out tax-free when you reach a selected retirement age. So crystallisation is a phrase that we need to get used to, really. That's the drawing of benefits typically, and very few people retire like a cliff edge retirement like what used to happen years ago. Many of us phase our retirement, hence the reason why we've kind of replaced that phrase retirement with crystallisation. When you do decide to draw your benefits out, crystallise your benefits, then normally you've got a choice. You can either secure your income for the rest of your life. That may be your only choice if you're in certain occupational schemes. You can do that through a scheme pension or an annuity. Or alternatively, a more common approach nowadays is that you could draw directly off your fund like you would a bank account in retirement, take what you need when you need it, which is known as flexible access drawdown. And you will pay tax on any income that you draw above the allowable 25%, which you're able to take tax-free, which is known as pension commencement lump sum. So all in all, there are good plans, retirement plans. Everything's there for you, ready for you to invest into it. So generally speaking then, we're able to make contributions each tax year up to the annual allowance. However, any personal contributions that we do make need to be justified by income, which is known as relevant earnings. And that relevant earnings must cover essentially the gross amount that goes into our pension funds. So tax relief is provided on personal contributions at the investor's marginal rate. If you're a basic rate taxpayer, that's 20. High rate taxpayer, that's 40. And additional rate taxpayers, that's 45. So essentially, you are going to see quite significant tax benefits in putting money aside for your retirement. The funds, as we've already said, will go in a very tax efficient way because pension funds have very little income tax and capital gains tax within them. And most individuals will build for their retirement through multiple arrangements in their lives, because nowadays very few of us stay with one employer over the years. Job for life seems to be something of the past nowadays. So the three different sources of retirement income tend to be from the state, and we've already mentioned that state pension age is 66 at the moment and likely to increase. Many of us will have some kind of occupational pension benefit, or at least a workplace scheme available to us when we retire. And also we may have made personal provision into a range of individual contract-based plans as well for our lifetime. So these put together, generally speaking, provide our retirement income. So what we're going to do is just break these down, get the basics of state, occupation and personal pensions on the next few slides. So starting with the state scheme then, we looked at this earlier on actually. We did notice this through the state benefits, that the basic state pension was available for those retiring before the 6th of April 2016. And there was also a series of top-up plans available, which we're going to look at in more detail on the next slide actually. The basic state pension was based on NIC contributions, and if you managed to get 30 years NIC contributions, then you qualified for full state pension in your own right. It's a taxable benefit, so any benefits that are drawn are taxable, although it doesn't always look that way with their state pensions because they are paid gross. They just represent the first income that you earn, and as such use your personal allowance first, generally speaking. So those of us that retire after the 6th of April 2016, or on or after the 6th of April 2016, we will get the single tier state pension, which now requires 35 years of NICs to be paid in full. You need at least 10 as well nowadays to get anything from the single tier state pension, and those NIC credits that you build up will mean that if you have between 10 and 35 years of NICs, then you'll get a proportional benefit. Likewise, the single tier pension is taxable in payment, albeit it's still paid gross. So on the old scheme, the old basic state pension, there were also a series of top-ups in inverted commas available for those that were employed. And they weren't available for the self-employed. None of these schemes were, but generally speaking, it gave you additional top-ups unless you were contracted out. Now, contracted out is a phrase from the past in many respects, particularly when we look at state pension nowadays. But what you were able to do was forsake your top-up pension in return for either a reduction in your NIC payments, or alternatively, you could forsake it for an equivalent amount to be paid into a personal pension for you during your working career. In other words, you kind of gambled that it would be better having the money in your own pension than the government providing it for you. Three different schemes existed. We had a graduated scheme between 59 and 75, SERPS, the state earnings related pension scheme, between 78 and 2002, and the second state pension which ran from 2002 to 2016. Now, whilst I wouldn't expect you to be tested on these necessarily in this exam, it's important that you understand that the accrual to this wasn't lost. In other words, you were assessed on the changeover to single tier pension. Everybody had a calculation done to work out their entitlement to these top-ups when added to the basic state pension, to see whether or not that was greater than our entitlement to the single tier. And when we retire, whichever is the greater essentially is what will be paid. So there is a little bit of legacy here for you to get a brief understanding of. So we're going to turn our attention now to work-based pension schemes, which are actually regulated by the pensions regulator as opposed to the FCA. And when we talk about work-based pension schemes, we essentially mean anything that's been set up by an employer for the benefit of their employees. So typically, we will explore with this defined benefit schemes, which are known as final salary and career average schemes generally, defined contribution schemes, also known as money purchase schemes, and the various different auto-enrollment schemes that we see nowadays. There's also group personal pension schemes that were alternatives to occupational schemes. We look at those in a little bit of detail when we look at the personal pension arrangements because they tend to be more contract based rather than these which are directly linked to an employer. So again, you don't need to know the basics on this, but we're going to look at each of these three different blocks in more detail on the next slide. So here we can see the three blocks that we talked about there, the defined benefit, defined contribution and the auto enrolment laid out. And we're just going to go over the basics of these for you. So defined benefit schemes, final salary schemes of old really, or career average schemes as a lot of them now are where you have a defined benefit, funnily enough. So your entitlement is essentially based on your salary, the years of service and the accrual rate that basically the firm operates under. These essentially do not rely on investment performance for you as the individual to provide you with any benefits. Your employer is taking all the risk. They're essentially giving you a formula to work out what the pension is going to be worth for you, and they need to put enough money into their pot to make sure that that formula can be paid to you when you reach your retirement. So they're often seen as the golden ticket really, the defined benefit schemes. Defined contribution schemes, money purchased arrangements, have a lot of characteristics that are similar with the personal schemes that we could put money into, in that all that's defined, all that's guaranteed is what goes in. So you'll normally pay a percentage of your salary in, as will your employer, and essentially what you get back is largely dependent on how much goes in that pot and what the investment performance of that pot is. So rather than the risk lying with the employer, on a defined contribution, the risk essentially lies with you as the member. And these sorts of schemes are far more common nowadays than defined benefits. Auto enrolment schemes essentially are the new kid on the block. So these are for those that do not provide either a defined benefit, a defined contribution, nor a qualifying group scheme. If you are actually employing anybody that's a relevant employee, you must offer them and provide for them a suitable pension and make minimum payments into that, minimum contributions. So essentially the auto enrolment scheme is not particularly a pension in its own right. It's more a philosophy really. It's a mandatory contribution scheme from employer to the eligible job holders. You're an eligible job holder if you're age 22 to state pension age and you earn above £10,000. The only people that can opt you out of this is you yourself, essentially. Only the members can opt out. And even if you do opt out, you'll be opted back in again in 3 years' time and will need to repeat the process if you want to opt out again. There is a government-based master trust called the National Employment Savings Trust that's there to help set up and reduce the administrative burden of anybody that actually fits this criteria of employing any eligible job holders. The alternative is, if your scheme that you've already got is good enough, is you go with one of the others that are explained on this slide or some kind of group personal pension scheme. We don't need to know a lot about the public sector schemes for this particular exam, but we're talking here in public sector about local government schemes, civil service schemes, teachers, firefighters, policemen, NHS, those sorts of things. And all of those pension schemes historically are defined benefit pension arrangements. They have a transfer club that you can actually move from one sector to another with. Essentially, if you resign as a teacher and go and work in the NHS, you can transfer your benefits over if it's beneficial for you to do so. And it's important to understand that that can be more beneficial to you than transferring it to a personal scheme. Some of these are directly funded, i.e. they have an actual pot of cash. Others are indirectly, notionally funded or not funded at all, i.e. the taxpayer picks up the bill for these. And if any of the schemes are notionally funded or unfunded, then you are not allowed to transfer them to personal pensions. So talking of personal pension schemes, we're going to turn our attention to the final block here now. And we're talking about individual pension contracts that we would arrange through an insurance company. So these are available in masses, really. There's lots of different choice available, and they're available to employees, the self-employed alike. Personal pensions are regulated by the Financial Conduct Authority as opposed to the pension regulator. And there's two main blocks of these that we need to worry about for this exam, and that is the personal pension regime and the stakeholder pension regime, which we will see the occasional question about. So personal pensions and stakeholders are a variation on a theme, really. A stakeholder pension is essentially a lower cost, more simplified version of a personal pension. So personal pensions have been in their masses since the 1980s, the late 80s in fact. They're contract-based individual schemes that you would take with an insurance company. And whatever your risk profile, whatever your requirements, you'll generally find that there's a personal pension out there for you. They can be used by employers to offer pension solutions. We've mentioned this before, group personal pension schemes, where they're actually a collective of a number of individual schemes. And the big advantage of group schemes for the employer is that it reduces their admin, and for the employee is that if they leave their job, if they resign, essentially they can take the pension with them. Now, stakeholder pensions came along in the early noughties, 2001 to be precise, as a low-cost alternative to personal pensions. They also had cap charges, so that's one of the reasons why they were low cost, was they had no initial fees, and the annual management charge was capped at 1.5% for the first 10 years and 1% thereafter. And you will need to know those numbers potentially for your exam. They also offered a simplified advice process. There was quite a large government-backed thematic review on why we weren't saving enough into pensions in the late 1990s. And the upshot was that people saw them too complicated and too costly, and basically it was too time consuming to set one up. So this was the response that they came up with, and whilst they're still available today and still around today, they were not perhaps the success that what was hoped. So next we turn our attention to the drawing out of pension income, and we kind of touched on this earlier when we did our basic overview, but generally from the age of 55 we can start to take our pension benefits out, and we can use the money we've saved either to secure an income for the rest of our lives or to put the money into drawdown and take an unsecured income, which is known as flexi access drawdown in the main at this moment in time. We can often withdraw a tax-free lump sum, normally up to 25%, and there's lots of flexibility in drawing those benefits through these flexi access drawdown and arrangements and the like. You can phase your benefits, or you can draw them all together. There can be restrictions on occupation schemes that you need to be aware of. Typically you can't take money out until the scheme retirement age without there being either permission required or potential penalties for taking out early. So that's always something worth considering, particularly on defined benefit pensions. So here we have, I guess, the three main types of access to income that you can have. So we could either secure income for the rest of our lives, done through either an annuity or a scheme pension. If we're in a defined benefit pension, a scheme pension is going to be the only way the income is going to be provided to you. If you're in a defined contribution pension, then generally speaking, you will be offered the opportunity of an annuity or a scheme pension, whichever you'd prefer to choose. If you're in a personal pension, then the way you'd secure your income is through a thing called a lifetime annuity. So lifetime annuities and scheme pensions provide a guaranteed income for the rest of your life. And within reason, you can form these in a way that you would want that's preferential to you. Much more possible on an annuity than a scheme pension. So what you can do on an annuity is you can add in a spouse's pension, you can add in a guaranteed period, you can add in escalation so that it goes up in line with inflation each year, all of those for a reduced initial amount of income that you'll receive. If you're in a scheme pension, it's likely the scheme itself will decide what benefits it provides for you, but there are statutory minimum requirements of escalation and a spouse's pension within them. Then we've got the unsecured income options, and these can be quite difficult to understand really, so we'll keep it nice and straightforward is what we need to for this exam. Drawdown arrangements is what they're affectionately known as. Here, having allowed for potentially a lump sum, we essentially treat our pension like a bank account. We can put our hands in and take money on a regular basis or on ad hoc withdrawals, but any withdrawal that we make essentially is going to be classified as if we'd earned that income and taxed accordingly. So the income is not guaranteed, it could run out. One of the big advantages though of unsecured income is they can provide greater death benefits, not that we need to worry about those for this particular exam. Finally, we're going to talk about the lump sum opportunities that present themselves when you can start to draw your pension benefits. Ordinarily, you can take 25% of your savings as a tax-free lump sum. And that's what most people will do. They'll take the quarter out, which is known as pension commencement lump sum. There are also ad hoc lump sum withdrawals that we can make from uncrystallised money, known as uncrystallised fund pension lump sums, but they're largely beyond what we need to worry about. So ultimately, what normally happens is that when somebody reaches either their scheme retirement age or age 55, they'll take the maximum they're allowed under their lump sum, and then they'll either secure an income for the rest of their lives or take it as unsecured income for the rest of their lives. If you take unsecured income initially, you can change in later life and secure the income at any point.